Good afternoon, everyone, and could I welcome all councillors, officers and members of the public viewing YouTube to this meeting of Avon Pension Fund Committee Investment Panel. My name is Councillor Sean Stevenson-McGall and I am the chair of the panel. I will now call out the names of the other members of the panel and ask them to confirm that they are here and present. Councillor Paul Crosley. He may be late. Councillor Chris Dando.
Present.
Thank you very much. John Finch.
Present.
Thank you so much. Pauline Gordon.
Present.
Thank you. And Shirley Marsh Hughes.
Yes, present.
Thank you. And I do believe that Councillor Paul Crosley has just joined us. Good afternoon, Paul. Can you just confirm you're present, please, Paul?
Yeah, I'm present now.
Thank you very much. Can I remind everyone to keep their background noise to a minimum and only to speak one person at a time and not to speak over other members of the panel. Please mute your microphones when you're not speaking and then unmute when I invite you to speak. Please indicate that you wish to speak by using the chat facility on Zoom by typing MIS, may I speak, and I will call you in turn to speak. Should panel need to take a vote in order to expedite a result or assume the majority position, so if you wish to abstain or vote against, please indicate that this in the chat when moving to the vote. But just for the members of the public watching us, just to say today, we're not going to be having any votes today because none of the items here today are for a decision, that we will just be discussing the items and any decisions that need to be raised to be made around the topics discussed today will be made either a future meeting of Avon Pension Fund Investment Committee or the full Avon Pension Fund Committee. Does anyone have any questions? Nope. In that case, I shall move on to item 2, apologies for absence and substitutions. Are there any apologies or substitutions, Mark?
No, Chair. You're all here.
Thank you so much. Item 3 on the agenda is declarations of interest. Have any declarations of interest been made, or does anyone need to make any now? I haven't received any, so I assume none. No, thank you very much. Item 4 on the agenda is any urgent business agreed by the chair, and you were pleased to know that there is none today. Item 5 on the agenda is items from the public to receive deputation statements, petitions or questions. Again, there were none today. Item 6 on the agenda, items from councillors and co-opted and added members. Today, there are none. Item 7 on the agenda is the minutes of the 26th of February 2021, which are both public and exempt. Now, normally this is where we would ask for a confirmation that these are a correct record. Given that we're not making a decision today, we will just note that they are available. And at our next formal meeting of Avon Pension Fund Investment Panel, we will formally agree them as a correct record of the meeting. So, what we would like to do now, before we go into item 8 on the agenda, which was on the governance framework, we have a guest speaker presenter today from Brunel, and we have David Vickers with us, who's going to present on us this afternoon. So David, are you here with us?
I am indeed. Thank you for having me.
Thank you very much. So over to you for your presentation.
Right, perfect. Thank you. Well, as I said, thank you for having me, councillors and Pension Committee. The first thing I thought it appropriate to do is to tell you who I am. So my name is David Vickers. I am the Chief Investment Officer of Brunel, and I joined Brunel in January of this year. So I'm relatively new to the seat. So I thought it very worthwhile I come to you as the leader of the team that looks after some of your investments, tell you who I am, a little bit about myself and where I've been, and try and establish some credibility up front, and then talk around the bigger strategic moves that are happening in markets that will and probably may affect your asset allocation performance, but also your intra asset allocation, your fund performance. And then I was given a list of questions by Liz, and they are very broad and big, but I shall attempt to cover them, or at least make comments on each one of them. But at any stage, if you'd like to ask questions, absolutely, please feel free to, of course. So in terms of who I am, I joined from Russell Investments, where I was the head of the multi-asset team for Europe and the Middle East. I'd been there for 7 years. I had been running somewhere in the region of £20 billion worth of assets for sovereign wealth funds, insurance funds, but really large defined benefit pension plans such as yourself. My previous tenure, I was a partner at somewhere called Saracen and Partners, which was a very large endowment fund manager, where I looked after some of the bigger endowments that we have in the UK. And then my formative years really were spent at Barings, again, in the multi-asset team. So I have 20-something years as a fund manager, building portfolios, running portfolios, and building and leading teams. So it's quite unique, actually, to have that amount of experience just running multi-asset. And I do hope that makes me a well-qualified individual to help you on your journey into the future as you seek the returns that you indeed need. Okay, so that's me. Happy to take any questions. I'll do a little pause each time, and if no one pops up, I shall keep moving on. So Chris, if I could have the first slide. So an awful lot has happened, clearly, as you're all very well aware, and I won't teach anyone how to suck eggs, so to speak.
Can I just check that everyone can see the introductory slide, first of all?
No.
Let me try that again.
If I keep talking while you put it up, Chris, there's no, that looks like it's going to work.
It's
Exactly. Great.
right.
What you'll find from me is I'll often start, if I'm allowed to, with the macroeconomic backdrop, but it's not macro for macro's sake. It's the macroeconomic backdrop will drive the returns of your portfolio and influence them both historically and going forward. So it is rather important that we start here. I'll then talk about the other risks and the questions that Liz, I think you and your team posed. Then finally, I'll touch upon what I'm looking to do at Brunel going forward to help you on your journey. So if I can just turn to slide 3, please, Chris, the next one. This is a very interesting chart, and this is driving pretty much everything that we see in markets today. This is broad money growth. Essentially, this is fiscal and monetary stimulus working together. So all the money that the government's pumped into the economy, into kind of unemployment benefits, into social security benefits, what central banks have done with liquidity, this is all the money that is sloshing around the system. To put it into perspective, and most of this was funded by debt, as I'm sure you're aware, debt today globally stands at 350% of global GDP. So to put that into perspective, we haven't been at these levels of debt since the end of World War II. Now, the amount of fiscal stimulus is extraordinary. So just in the US alone, they have committed 25% of their own GDP last year to helping pull us through the crisis. And in places like Japan, that number is actually 54%. Now that's important because it's driving flows in markets, it's driving behaviors, it's driving arguably inflation, which we'll touch upon. The big difference between now and the global financial crisis, when again, stimulus was used quite aggressively, is that in the global financial crisis, the money was directed towards the banks. Here, it is directed very much to consumers and corporates. And so as we move out, touch wood, of the virus period, and we start to become vaccinated around the world, not just in the UK, this money will be unleashed, I think, as a torrent of pent-up demand. If I can just turn over, Chris, because this is some of the ramifications of this money. So on the top left-hand side, we have what's called the PMI, the Purchasing Managers Index. Basically, it's broad measures of economic growth. If the line is above 50, that indicates an expansionary economy. Beneath 50, it's contractionary. You can see the stark lows we hit at the worst of COVID 12 months ago, and you can see where we are subsequently. And this is for the US, it's for Germany, it's for the UK and the Eurozone, but any country will look like this. In fact, China looks a little bit more aggressive. We are very much on the path to recovery. However you look at it, and I've tried to do a broad range of graphs here. So on the far right, you have US retail sales. And this is what I mean, that is an extraordinary number at all-time highs. And that's because money has been dropped directly into the US consumer's pocket. They have physically picked up checks from their equivalent of the post office that most people then went out to spend. The bottom left, you see housing starts. Again, you see that drawdown and that very strong bounce back. And on the far right, just as not to add too many charts, we have the US leading indicators index. So these are a whole wide range of economic indicators that are set to lead the economy forward. And again, you can see a bounce back quite considerably into positive territory. That is very important because the further ramifications of that is what we can see on this chart. The price of oil going up, the price of copper on the far right-hand side hitting all-time highs, soybeans, corn. In fact, any commodity you want to look at has the same effect. In fact, there was a lovely report I read this morning about the price of your breakfast. So coffee, milk, sugar, oats, and orange juice on aggregate have gone up by 28%. For those of you who are still meat eaters, if you throw in a sausage, it's gone up to 38%. This is an issue. This is the beginnings of cost inflation running through. It's a bit of an issue for us in the developed world. It's even more of an issue, arguably, in the developing world, where the amount of your budget you spend on food is a much bigger proportion. And that is the darker side of food priced inflation. And the UN's kind of food index, again, is hitting all-time highs. Now, why is all of this important? Well, if inflation does indeed continue to come through, and I'm sure you're aware, if you can't pick up a paper at the minute for people talking about the fear of inflation, which we'll touch on in a minute. But if inflation does continue to rally through markets, a number of things happen. Firstly, it eats away at the real returns of your portfolio. If you generate a return of 7 and inflation is 2, then that's a 6% real return. If inflation goes to 3 or 4, then that's a much lower real return, because arguably that's what you care about at the end of the day, a return on your money above inflation. Clearly, for people such as yourselves, you have inflation-linked liabilities, they will go up. But it's more than that, actually. It's not just inflation, because a little bit of inflation is a good thing. That 350% debt that I talked about is going to be paid down over time, but it can also be eroded away by inflation. However, if inflation continues to push northwards and startle central bankers, there is a real chance they start to increase interest rates. Now, as you're probably aware, for those of you that have mortgages and credit cards and the rest of it, your debt repayments are relatively low. The interest rate repayments are relatively low. They go up. The price of your mortgage goes up as interest rates go up. The price of corporate debt goes up as interest rates go up. The financial conditions start to deteriorate because it's more difficult to pay back debt, and there is a lot of debt out there, both at the corporate level and at the government level. In fact, the only people who have better debt profiles today than they have historically is the consumer, because on aggregate, the consumer has saved money. Sounds like an odd thing. There are obviously pockets of people who haven't and pockets that have, but on aggregate, the consumer is better off because of the stimulus that's been pushed through the economies. Now, the other thing this happens, as interest rates go up, the risk premium that is applied to other assets needs to adjust. And apologies for teaching you to suck eggs, but essentially, if equities or property, let's say take property, is there to generate a 7% return for me, and I can get nothing in the bank, that's a 7% return over the risk-free rate. As interest rates go up, and let's say they go to 2%, suddenly property, while still giving me 7%, is only giving me 5% more than the bank. So if you believe that that 7% risk premium is correct, it's now shrunk to 5. The only way for that 7% risk premium to reassert itself is if prices fall to increase your expected return. Interest rates are the bedrock of the return expectations of every single asset. It's the foundations. Again, an 8% return is good, not so good if I can get 7% in the bank. Very good if I can get 2% in the bank. So there will be some digestion problems if interest rates go up. And that is a big if, because the jury is still out. Clearly, year over year, it's rising at very rapid levels, but last year was it was at the depth of the recession. So you would expect that. You would expect some bottlenecks as supply starts to come on. You would expect kind of big demand as this groundswell of people spending their money that have been pent up or haven't been able to spend. I mean, there is only so many things you can buy on Amazon. When we're fully let out of our houses, there will be a bit of an unleashing of spending. The question is, does that lead to longer term inflation? That is a serious question to ask yourselves, your committees and your advisors, because that really is one of the biggest things that's on the landscape, absent all the political risks and things we don't yet know about, that will determine whether success is achieved in the short or the long term. The other problem we have a little bit today, because a little bit of inflation, even moderate inflation, is a good thing, but it is that tightrope. If inflation leads to higher interest rates that are quicker than the market expects, there needs to be a buffer. There needs to be a margin for safety. And Chris, if I can just ask you to turn over to the next slide. The problem is a little bit today, there isn't much wiggle room in valuations. What I'm showing on this chart here on the far left is the S&P. That's the US stock market. And I'm showing the valuation metric as described by what's called a CAPE measure. It's a cyclically adjusted price earnings. So it takes out the variability that 1 year earnings might be up and 1 year they might be down. It's a much smoother average. And what you can see is the 5-year bar in orange, and actually looks like the 10-year has dropped off, but the market is quite a bit above both its 5 and its 10-year average. So one could call the US equity market expensive. In fact, I think it's fair to call it expensive. However, when one looks at the FTSE, the UK stock market, you can see it is a relatively cheap market today. So there are definitely pockets of undervaluation. However, the US equity market accounts for 66% today of the global equity index. It's why that adage, the US sneezes and we all catch a cold. There isn't a world that exists, sadly, today where the US equity market doesn't fall and take the global market with it, because it is such a dominant part of your indices. But where the valuations look a little cheaper is, again, when you compare them to the interest rates, which are zero. If interest rates go up again, they start not to have that valuation pillar. So that isn't to worry anyone and say these are nosebleed territory. They're not. But there isn't much room, there isn't much margin for safety. And we are rather entering a period of not quite the unknown. I mean, the future is always unknown, but we're coming out of COVID. We still don't know how behaviors are going to work. We don't know where the leverage is. We don't know what happens when all the fiscal stimulus measures and the forbearance that has been granted to companies starts to come away. When the tide goes out, there is arguably going to be a bit more, a few people will be caught with their trousers down, I believe is the slightly unpleasant expression. I mean, to put that into perspective, last year, bankruptcies were lower. So they were lower in 2020 than they were in 2019. Now, you think about all you've read about in the paper. That is, it's a fact, but it is masked by the fact that people have been propped up with support. Already, we're starting to see a lot of bankruptcies come through, because an interesting fact is that bankruptcies tend to happen not during a recession, but as you come out of the recession, because then you have to rebuild your inventory, rebuild your working capital. And if you quickly run out of money, whereas actually in a recession, you don't need so much money. You cut back, you kind of hunker down. It's only when you go to expand do you need that money. So we will see, continuing this year, a number of companies that will probably go to the wall. That isn't to say they're mispriced. Actually, they're probably quite well priced for it, but there is still an undercurrent of uncertainty as to who will and who won't struggle as we move out of COVID. The next slide 7 talks about credit spreads. So again, without wishing to belabor the point, a credit spread is the compensation you receive for default risk. So you have a government bond, and then on top of that, you have a margin that is to compensate you for taking Vodafone's risk, for example, as a corporate, or Diageo's risk. What this chart shows is where spreads are today. And you can see the very big spike on the far right-hand side. That was where COVID hit us in March. And you can see the decline in spreads ever since. And the spreads go down, you make money, but the compensation for future periods shrinks. And you can see by and large, we're back to where we were pre-COVID, which were already kind of closer to the tights. So a word of counsel that I would suggest that there is not much margin for error in valuations, certainly in the credit market, particularly when you also think that interest rates are at zero. So arguably interest rates can only go up from here, which hurts credit markets, and spreads are already close to their tights. So the compensation is relatively small. What I would suggest on the back of both those two slides, I would say, is that you should expect a decade of perhaps slightly lower returns than you've had over the previous decade, at least in listed market space, because your valuation point really sets your 10-year return. And valuations are, in most instances, tighter or more expensive than they usually are at the beginnings of a recession. The last chart I have on here is just one for interest, and this you'll see this running through your fund performance. Basically, up until November last year, for 10 years, anything that was growth orientated within the equity market had done very, very well. Amazon, Tesla, Google, the FANG stocks, Facebook, Apple, etc., etc. Value stocks had been yesterday's news. They have underperformed for a disproportionate amount of time. What you had since what's been called Vaccine Day in November, when Pfizer first got approved for use in the UK and ergo set the tone for the rest of the world, is value stocks have bounced very, very aggressively. And that's continued this year. So at the top of that chart, you can see the yellow line is the value index, right at the top of the pack. At the bottom of the pack is the growth index. So that is the growth orientated technology-based stocks. Quite a large diversion. You typically always get this at turning points. But what is exaggerating is that when we went into the crisis, anything that had the word Zoom in it or Amazon sped off to the moon, quite frankly, and got over expensive. So we are recouping some of the underperformance of value. And this is one of the things Liz asked me to touch upon, because within within some of your portfolios, you have a bit of a growth bias. What I'm pleased to say is that we are in the funds keeping pace, because we also have some value, what's called the value factor, to compensate for when the markets change and gyrate and leadership changes. So on the last slide here, I've just really put the conclusions from all of this macro stuff, the things one should think about, the questions you should ask. So the bull first, so what are the good things? Well, the economies are thriving, and we are well on the way to a consistent and considered recovery, driven by the stimulus that the central banks and the governments put in place last year. Vaccine deployment, I know we're doing quite well in the UK, not so well maybe globally, but the markets are looking through to an end of lockdowns. There is a lot of pent-up demand, and I've tried to book a holiday recently in your part of the world, and I can't find an Airbnb for love nor money. There is a lot of demand to spend some of that pent-up demand, which will be unleashed on the economy and help companies and corporates and consumer cash flow move forward. There are high debt levels, yes, but if interest rates stay low, that debt is affordable. And we are early in the economic cycle, which does usually mean you have a long runway for growth. But, and this is the bearish points, the things that keep you up at night, equity valuations aren't cheap. The boost from low interest rates that we've seen over the last 10 years, really since the global financial crisis, is over. Credit spreads are low, so compensation and rewards on offer is lower than it has been historically. And today, at least, companies are more indebted than they have been forever. Now, debt is a fine thing until something happens and makes the repayment of that debt difficult. And then finally, as we mentioned, inflation is definitely picking up. Some of that is a base effect, i.e. where we were last year and where we are today. But if it persists and it starts, that genie comes out the bottle, it certainly can cause us some issues. I will just pause there before I answer some of the questions that were posed by Liz earlier and ask if there are any particular questions. I'll take that as a...
Actually, David, I had a question.
Yes,
in terms of all the big pictures of macro issues that you've highlighted, just wondering, do you think that's going to make it any easier or harder to invest in a climate-orientated way?
There are some short-term struggles, which is the oil price is having a bit of a tear. It's going up quite aggressively. So that is unhelpful. Banks also are value stocks. And actually, as you know, the two worst sectors in terms of climate change are usually, not always, but E&P, exploration and oil companies, and banks who fund those companies. Both of those are doing very well at the minute, having been a laggard for a very long time. But that's a finite amount of time they can go on for, quite honestly. So what I'm seeing in the portfolios today even those of our portfolios that are more sustainably edged than the others are actually starting to keep pace. Because what's happening, you've had this dash for trash, so-called, and now actually those stocks are broadening out. The rally is broadening out from just cinemas and Hertz and rent-a-cars and everyone who was in the crosshairs of COVID. And the quality factor within our portfolios is starting to play. But over the next 10, 20 years, there will definitely be lumps and bumps in performance where, and we've just enjoyed a very good period where all things growth and sustainable have done particularly well, and then you'll get a slight reversal. What was very interesting yesterday on the news that Shell lost the court case. The Dutch government is now enforcing them to hit some targets, which actually doesn't change their business case, but certainly perhaps addresses the speed by which they have to change. And one would hope it changes the board behavior, because they were suggesting they were going to do these things anyway, but that was through peer group pressure and people like us. Now the legal side has kicked in, and they're challenging it, quite frankly, but they're obligated at the minute to hit those targets. And so for me, the writing is on the wall. It really is. I think that the train has left the station for companies that are no longer, or at least aren't preparing for net zero. Because quite frankly, at some stage, these oil companies, as they stand today, have the capacity to be the solution providers of the future. But we have to see them make that transition, and not all of them are. It's why Exxon got two new board members also yesterday. But this isn't a problem for the longer term, actually. And as every company we look at is pledging towards net zero, the opportunity set widens and widens and widens, and it's already quite big to start with. So I don't foresee any medium-term problems. In the short term, yes, you're going to get lumps and bumps and periods of out and underperformance, because nothing is ever linear, as you know. Which kind of brings me on to the other key trends and considerations that Liz mentioned. I know I'm slightly getting close to time, so please do hit the timer when I run on. Unwinding of fiscal stimulus. At some stage, I've already addressed this. When the tide goes out, when forbearance stops, when private renters have to kind of re-engage with the people they're paying their rent to, or perhaps haven't been paying their rent to, the clock is ticking on that, and we'll see who survives and who doesn't. The bigger thing on the agenda also is trade tensions. So if anyone thought that Joe or President Biden was going to be a friendlier face to China than Trump, I think they were proved wrong in recent calls. I think he'll do things in a more diplomatic manner. I don't think there'll be as much saber rattling, but the US for a long time, even under Obama, had moved away from cooperation to competition. And those are the quotes that are coming out of the call that President Biden had with President Xi. So that is going to be a long-term tension on the global stage. And actually, the noises that have come out of the US administration have been more aggressive than people were thinking. I mean, he's just recommissioned his intelligence services to double down and try and decipher whether or not the virus did come out of Wuhan or not, which was very much a Trump thing. Now, I think he'll do things more diplomatically. I think he'll use the right channels, and it won't be tweets. But nonetheless, I think the days of kind of cozying together have rather ended. So that is an ongoing, not a risk, it's a changing of the guard, changing of the landscape, and our companies will have to navigate that. I mean, the other thing about China that's interesting / difficult to navigate, I guess, is the human rights issue and the Uyghurs and all the issues that come with that. I guess what I have to say there is that when you look at Chinese companies, it's very difficult to disassociate. Do you look at the company or do you look at the country? Because some Chinese companies are divorced from China, the government, as much as they can be, but the Chinese government has a very long arm. You also have to look at Western companies. There were a number of countries and companies that got caught up in the Uyghur situation. It is the world's largest. I think it produces something like 35–40% of the world's cotton. It produces something like 70% of the world's tomatoes, which was news to me. And some of the components that go into batteries and particularly electric car technology. So the issue one has today, and when we speak to our managers and our companies, it's no good knowing who your suppliers are. You have to know who your suppliers' suppliers are, because that long chain of outsourcing has to be guarded to make sure that there are no issues with modern slavery, which is exactly what we're talking about here. And we were talking about not that long ago with Boohoo, the UK, company that got caught up in a smaller scandal, but certainly in the same genre. So there is no easy answer to how one should or shouldn't invest in China. We have just put through, since I've joined, a big piece of work that we're still following up through with our managers, with our counterparts and our partners to see what the best route to take is. For us, it still remains engagement and pressure groups, but on Western companies as well as, quite frankly, Chinese companies. Climate change. I mean, as you're aware, Brunel has always been at the forefront of the UK, as have yourselves, actually, quite frankly, allowing us to push that plough for you. And so whilst everyone is somewhat jumping on that bandwagon, and I saw some slightly damning statistics yesterday that 70% of funds that now call themselves sustainable have done so in the last 12 months. You know, there's a lot of people jumping on the bandwagon because there's a huge commercial push to do so. We have always been pushing that wagon, building that wagon, I would suggest. And with Faith Ward, who is our Chief Responsible Officer in my team, is the chair of the IIGCC, who are the people responsible for pushing people towards and coming up with a framework to moving towards net zero. So these issues have always been embedded in our work, and only will they grow so as things like you know, the surprises that both Exxon and Shell got over the last couple of days continue to come from the forefront, because we're making great headwinds and great strides. One of the things that I'd just like to leave you with, perhaps before I take some more questions, if there are any, is that we are now actually working with index providers to ensure that the indexes that they come up with are fit for purpose, are transition worthy, and also give a lot of diversification and the right type of characteristics you would expect from a benchmark. I'll just pause there because I can see a hand has come up.
Thank you very much, David, for that. So the first person I have is Councillor Crossley.
Yes, thank you very much. That was very interesting. First of all, I'm absolutely pleased with what you say about we being a leader in the sustainability agenda and that sort of thing. But if everyone is now rushing at it at such a speed, does that have the chance of creating something, you know, like a South Sea bubble effect, you know, with everything becoming overvalued and disproportionate if people are just piling money in because they're following the bandwagon? Yeah,
no, it's interesting. So weirdly, what's happened, as everyone seems to have jumped on the bandwagon, as is often the case, actually that part of the market is rolled over. There's an adage in the markets that there's a difference between traveling and arriving, and when you arrive at your destination, it's rather too late. And so all these people have jumped on quite late in the day, and in the short term, they've rather suffered from it. But when I say everyone, I do mean the UK particularly is quite far evolved. In the global scale, many people are well behind, and our US cousins are in the developed world amongst the furthest away from moving down this path. They're only starting to have those conversations, and President Biden is pushing that agenda. But for them, they have legal challenge as to what fiduciary responsibility means, whether it means making your money work for good or whether it means just hitting the return target you need. And so actually they are, as I said, they're 66% of the world equity market. They're actually more than that of the ownership of the US equity community, or the US citizens own 70% of the FTSE. It's amazing. We've given away our market, perhaps because it's so cheap, but no, the groundswell at the minute is from the UK, not yet the globe, sadly. So we're not near a South Sea bubble just yet, thankfully.
Thank you, David, for your response. Then I have Shirley, then Pauline.
Thanks, thanks, David. That was a really interesting presentation. You touched on sustainable portfolios, and I also wanted to ask, given the focus that Brunel has on climate change, would you argue that all of your portfolios are sustainable?
Yes. So the only ones that I would say aren't are the passive portfolios. So anything that is active is sustainable. It has a very big ESG input to it. Now, one of them is called sustainable. Because it goes a little further. It doesn't just have ESG values, it's deliberately skewing to invest in companies that are providing solutions. So it's impact orientated. Now, we had this conversation actually at one of our meetings. We were saying perhaps we should rebadge them and call them, but we feel that it's just so embedded in our process. It would seem really glib to suddenly throw that marketing spin to it. So they are all, the only ones that aren't are the passive tracking indices.
Yes.
Even our debt products that we're launching now, and the debt market, the bond market is a world behind the equity market in engagement. We put so much effort into finding the best managers that not only provide the best returns, but do so in a sustainable fashion, even in more difficult areas like the bond market, where quite frankly, it's a bit of a backwater when it comes to ESG considerations.
Indeed, yeah. Okay, thank you. Thanks.
Pauline.
Hi, no, it was really interesting. Just going back to the macro picture, can you think of any sort of key differences between developed and emerging markets?
Yeah, so emerging markets are cheaper on aggregate than developed markets, particularly cheaper than the US equity market. They also benefit from a weaker dollar. So there's another positive in their favor, which we're seeing today. So the dollar, well, certainly sterling is going up, but actually the dollar is going down against most markets, which makes their debt easier to fund, quite honestly. So that's a good tailwind. And on and off, they have been a laggard. The only issue in emerging markets in a pure sense is that China is 50% of the index. And within China, you have, in their equity market, you have about 30% of their market is state-owned enterprises who really do exist as an extension of the state rather than as an extension of shareholders. So this is part of the governance, the G angle in ESG when one invests in China. But there are some super companies there that actually have a lot of trade intra-region as well. So you can pick up a diverse return stream in some of the companies we look to invest in.
Thank you. I have a question for you, David. I might to do some more geopolitical issues around Taiwan and microchip production and issues around COVID vaccine in Taiwan and the lack of it, or the lack of a high percentage of vaccine in the country there, and them supplying everything for the rest of the world. I think it's 80% of the chips come from Taiwan. So I was just wondering, what's your view on that geopolitical issue around Taiwan and China and how the new American administration might react to that?
It's interesting. Obviously, that's been the Taiwanese-Chinese, let's call it disagreement, has been around for a very long time, clearly. Trump poked it, I would suggest, in very visible ways, talking to Taiwan directly, making the first call that an American president had for a while. I think Biden is more diplomatic than that, but I don't think that is going away. And what China has promised to do, that the document that's been most overlooked, I think, in the last 2 years is the last Chinese plan. They committed, and what China has done historically is when it commits, it doesn't reach its commitments because it's a bit of a command economy. It does help if you can tell everyone what to do and they have to do it. They decided they wanted to be a military power. It's the first time that's ever been said about China. Usually they're very low key on that. They said they want to be at the forefront of technology and chip manufacture. And they said they wanted to put themselves on the world stage. If you were sitting in Taiwan, that would make you nervous. But I don't think, quite honestly, that we're anything, and who knows, I mean, it's difficult to talk about, but I wouldn't expect there to be a military conflict with Taiwan. This has been going on for so long. There's no upside for anyone doing it. What you commented on actually is particularly important for financial markets. So a lot of the chips do come from Taiwan, but actually they're not all manufactured there. Some of them are put together there, some of the IP's there. The problem we've had, and what COVID really showed us, and Brexit to a little bit, is that we have a global supply chain. There isn't I can't think of one product that is all manufactured in the same spot. And one of the very early indications for me when I was running money somewhere else, I went to a client in February, in the UK, they're in northern England, and they were struggling because one of their parts came from Italy, one of them came from Saudi, and one of them came from, I forget the other country. And because imports had stopped, ground to a halt, because some of the factories were closed, it created huge problems for that company. They couldn't complete their orders because their widget that they needed to complete wasn't there. So it's very much like the chip analogy. What is happening is people are starting to onshore. The years of going to low-cost locations actually are being a just-in-time supplier of things. So you don't order the next lot until the last lettuce has left your shelves, as you do in Tesco's. Supply chains are coming in. A lot more of the component parts are going to be made locally, or at least closer. So within Europe, if you're a UK corporation, most of it's going back to the US. So onshoring has been a big theme there. both from actually Obama, but also Trump, clearly trying to pull things back. So this has an impact for margins, but there are some pinch points, you're right. So many of the chips are finally manufactured in Taiwan, but actually lots of them are manufactured outside Taiwan. They go back in, get reassembled and shipped out. So actually, there's many ways one can square that if there was going to be an issue. You just don't ship them back to Taiwan, you develop another factory close by, et cetera, et cetera. So there are ways around all of this. I don't see big shortages in the long term for any of these things, but I do think those supply chains come down, which means margins go down also, because if you're not, using your supply chain in the most margin efficient way, and you're doing it for business safety reasons and securement and resilience, then that comes at a cost, which is one to look forward to.
Thank you very much, David. John Finch is next.
You're going to hate me for this question, David. You mentioned inflation.
Yes.
And I know it's a difficult call. Do you think it will really take off, or is this just the bounce back from the lows and it will flatten? Because that then has a knock-on impact on potential defaults. Yeah, what's your view?
Yeah, so I have a view, but it's in keeping with the Federal Reserve's view, and this is me being super pragmatic and having enough scars on my back from misforecast things over the last 20 years. So the Federal Reserve, so the US Central Bank, has better economists than I have at my disposal. They have all the data that doesn't get released. They are suggesting that the majority of this is bounce back and will fade. But actually, what's more important to you and to your committee isn't actually whether inflation comes back, it's whether markets think it will. So it's that Keynes quote, isn't it? You don't have, in a beauty contest, you don't have to judge who's the most beautiful, you have to judge who other people are the most beautiful. So you have to worry about the market's reaction, even if you think ultimately it's going to be wrong. And what we're seeing at the minute is the market getting very much caught up in an inflationary fear. So actually quite a lot of the damage may have already been done, quite honestly. My personal view is that in the short term, we don't have to worry about it, but markets always overestimate the short term and underestimate the long term. I do think the cycle has changed. We have had arguably 30 years since the 70s of a deflationary theme and interest rates coming down. I do think we have hit that trough and will start to turn up, but I do not forecast kind of hyperinflation or inflation akin to what people would have experienced in the 70s with interest rates running at double digits. But I do think we have changed. I do think some of the secular trends that have brought deflation around the world have started to ease. So demographics are changing slowly. That what I just talked about, offshoring, going to cheaper manufacturing hubs, that is stopped and starting to come back the other way. That is an inflationary trend in of itself as well. So I do think inflation picks up from here, but I don't think it causes the most aggressive of reactions. The problem I worry about is people might start to think it will. And so markets might start to react, even if, like all of the rest of us, they're putting their best guesstimates to their portfolios.
Thanks.
Do any other colleagues have any questions for David at this moment? I'm not seeing any. So David, thank you very much for your presentation on sort of the macro outlook and some of the other risks and issues that we need to be thinking about as we look at our future investment strategies here on Avon Pension Funds. So most helpful, and we look forward to having you and your colleagues come to future meetings, hopefully in person. Hopefully in the future, either in Bath or wherever we have them held. So thank you very much for you and your team for joining us today. Thank you.
Lovely weekend. Thank you, Nat.
Thank you. So we inserted that presentation. So what we think is best to go for now is we go to item 10 on the agenda, and that is on our review of investment performance for the period ending the 31st of March 2021. And I believe our officer, Nathan Rowlingson, will introduce this item for us.
Yeah, absolutely. Thank you. So, I mean, I only had one point to talk about before handing over to Steve to take us through his revamped performance report. And that was around the pace of deployment in the private markets portfolio. So after what seemed like quite a long delay, the secured income cycle 1 portfolio is just under 70% drawn. And while I think the pipeline for the renewable infrastructure and the private debt portfolios is looking quite strong, there is a sort of significant capital chasing private market opportunities at the moment. So we could well see that the pace of those drawdowns slow while Brunel sort of identify the right opportunities to onward deploy our capital. So I think Steve would probably concur with that view. But yeah, that's all I had to say. Unless there are questions on the covering report itself, I just pass straight across to Steve and Josh. Thank you.
Thank you, Nathan. Does anyone have any questions on the covering report? If not, we'll go to Steve. I'm not seeing any, so over to you, Steve.
Okay, thanks. I'll just bring up the report. Yeah, so just by way of background, so this is the first time that we're talking about a kind of new revamped report. So the previous one was probably more manager focused and on the actual performance of the individual portfolios. But now that you're pretty much you're very well transitioned to Brunel, you should be looking for Brunel to provide more of the sort of manager monitoring. So we've had a refresh of our report. I discussed it with Liz and Nathan. And so what we're trying to get to is a position where our report is more strategic in nature and allows you to sort of think about, consider some of those more longer term, big picture strategy issues. So the report that we've put together, we'd say is still in draft to an extent, in the sense that if you've got any suggestions of something that you'd like to see, or if you want us to sort of change anything, then we can, we're very happy to do that. So I'm just trying to, yeah, here we go. Here's the report. So Josh is going to begin by taking us through the first few slides, and then I'm going to sort of pick out some key other issues.
Thanks, Steve. So yeah, we'll just skip over the exec summary, just because the majority of the detail is actually in the report. So in terms of the market background, wasn't going to go into this in a huge amount of detail given the conversation that we just had with Brunel. Just suffice to say that growth markets obviously had a very strong Q1, and we saw big increases in government bond yields, which are negative for returns on fixed income assets. In terms of the longer term trends on the next slide, again, the impact of the last year is very clear. In terms of equity market returns, again, it's that same sort of theme, with 2020 really dominating the 3-year picture as well. The next section is just a summary of our market views, and appreciate there's quite a lot of words in these slides. The key highlights here are, again, fairly similar to the views that Brunel have expressed, in that we remain positive on the outlook over the next 1 to 3 years. We look at equities quite favorably, same for growth fixed income, so high yield bonds, multi-asset credit, those sorts of assets, albeit we're slightly less positive on growth fixed income than we were last quarter. The main reason for that is just because spreads have come in so much. Again, similar to what Brunel said, there's just less cushion if defaults were to pick up from here. The next section, you're probably familiar with. Again, we just go into a bit more detail on the underlying components of equities, growth fixed income, and defensive fixed income. We haven't really changed our views on the equity sectors, the underlying equity components during the quarter. We still think the outlook is positive for emerging markets, small cap as well. The way that we do our relative views is on a sort of zero-sum game within each asset class. So within listed equities, in order to be overweight emerging markets and small cap, we have to be slightly underweight global equities. You might notice it says global sustainable equity. That just reflects our sort of longer term view that if you're going to be investing in global broad market equities, that should be done in a sustainable way. So we've sort of formalized that by changing how we describe broad market equities in these portfolios. Growth fixed income on the next slide, slight change there in our views, relative attractiveness between loans and high yield. Mainly because, again, on high yield, it's the fact that spreads have come in. So we see there's less upside there than there was. And we think loans are probably a better place to be within the growth fixed income space. the next slide.
Sorry, Josh, just to give you an example about how we can use this type of framework as well. So if our views on loans and high yield went deeply into the red, so we thought that was particularly sort of unattractive, we'd actually initiate a discussion with officers about maybe making an asset allocation change, and not just relying on the managers within Brunel. We're not saying we would recommend a change. It's just that kind of initiation and seeing if it is worth doing that from your overall investment policy perspective.
Thanks, Steve. So the next slide just outlines our views on what we've termed defensive fixed income. Wasn't anything I was going to particularly bring out here. No real changes to our views of that over the last 3 months. The next section goes into sort of the real estate market. The key thing to bring out here is the grey boxes are our views back in January, and the blue boxes are our views on real estate in April. As you can clearly see, we've become a lot more positive on the market. Particularly core real estate is worth highlighting. Just as the economic recovery takes hold, we're expecting that sort of decline that we've seen in property valuations to stop, and we've already seen a reversal of that in the UK market. The next section, we go into the funding level and risk. This should be familiar from previous reports. This is what goes into the committee reports. Main thing to highlight here is that improvement in the funding position over the quarter. So the assets returning 2.7%, whilst the liabilities only increasing by 0.6%. So seeing that improvement in the funding level continue that we saw from Q2 last year. So as the recovery, the bounce back in markets, particularly growth markets, took hold. This is a question, Pauline.
Yeah, I just had a question on the VAR figures in terms of the equity option. So I think the offsetting VAR is about double what it was under the static, if I've got that right, which is great. I just wondered if you could talk a wee bit about that. So that's a great benefit for us. And I think I asked before what it would be, and I think it's quite hard to model. So maybe just a little bit around how you did that.
Yeah, no, that's a great question, Pauline. Great spot. So just to clarify, we have changed the way we're modelling the equity protection. So before you had the equity protection in place, it was a static structure. So it was in for a defined period of time. So we do some modelling, but you can do like fairly accurate modelling because it's a defined time period. What we've done now, we've assumed that the protection qualities are permanent, so they're indefinite. So from a modelling perspective, we just assume continuous protection is in place. So that's the kind of a high level description of what's going on. We can provide you, Pauline, with a more technical answer if you'd want, but another impact of the new structure that you've got in place is we're actually reporting quite a marked reduction in the overall level of the VAR. And so just a reminder, the VAR is basically an assessment of a downside event of how much we could see the value of the assets for over a sort of 3-year period. And it's useful to just be aware of because we're always running a certain amount of risk in the portfolio to help achieve the long-term returns that we need. And so as at the 31st of March, the VAR is, let's call it $1 billion in round terms. Has come down by about 300 million in round terms since the start of the year. And that's broadly a reflection of, we had a static equity protection. Now we've got that sort of rolling permanent dynamic protection in place.
Great, and I'll take the detail, but I can take it offline.
Yeah.
Thank you.
Yeah, lots of formulas to the power of 3 and other formulas going on, Pauline, if you want that.
Excited already.
Yeah.
Thank you.
Okay. So I was going to pick up on here. So yeah, in terms of some like new style analysis that we're showing, this is an important chart, and I think actually just dovetail well into some of the messages that were coming from David Vickers from Brunel. And so what we're doing in this slide is we're assessing how the expected return on the current investment strategy has changed since the valuation date. So the valuation date was 31st of March 2019. The analysis that we're showing is based on our latest capital market assumptions at the end of March this year. So headline message is that the expected return on the strategy has come down. It's come down by about 0.5% from 5% per annum to 4.5% per annum. And these are 20-year projections. And so what we've seen is that risk premiums that we assume on pretty much all asset classes have come down by various percentages. And the aggregate impact of that is this is 0.5%. Now, what that means from a strategy perspective and linking it to the funding is that the probability, so the level of confidence that we have in being able to get the return that's going to meet your discount rates has come down. So at the valuation date, it was 63%. Based on the latest analysis, it would be kind of 47%. So kind of you think, okay, you know, what does that mean? What are the implications of that? Firstly, we're saying we just view this as information. So we're giving you an idea of, you know, if we were to do the valuation, if we were to do an investment strategy view, we'd be talking about lower investment returns. And that in the future, that might have some implications for us from a strategy perspective. So we might have to be creative and think of ways of actually how we can increase the expected return in the future to help with the probability. But doing that, we'd need to be careful because you could actually end up in increasing risk, which might not necessarily be the right thing to do. Having said that, I'd also say and remind you that, you know, when you're doing an actuarial evaluation, and that's the key point really in being able to sort of come up with like a balanced solution to make sure that ongoing costs of providing pensions are affordable, is that you know, expected return and the confidence that we have on it is just one of many assumptions that goes into it. So we would work with Paul and we look at all of the assumptions, and it may be that actually this doesn't necessarily need to have any sort of direct impact on the outcome of the valuation. So just wanted to sort of put some things in perspective, but I think it's important to note that long-term picture is that returns are coming down, and the probabilities of achieving the discount rate have got a bit harder. So I should have mentioned before, another factor that's resulting in the probability coming down of achieving the discount rate is because compared to the valuation date, in effect, CPI inflation has gone up in value. So I appreciate there's a lot there, but I think there's some questions that have come in.
Yeah, I think John is next.
Yeah, I guess when you look at this first sight, it's a bit worrying that probability of achieving that discount rate has come down. But in valuation terms, because over the last couple of years, assets have outperformed where we expected to be, we're actually starting our projection from a higher base. We're better funded than we were at previous times. Is that right?
I think what you said is right, John, but I think basically is you don't need to panic or think anything are going to have to sort of dramatically change, because the valuation outcome really is dependent on a lot of assumptions and a lot of factors. And just because I'm saying now returns are coming down and there's a challenge on the probability, don't assume that is going to lead to an impact of higher contribution costs, because, you know, we work well with Paul, and Paul will be sort of very focused on looking to sort of look at a broad solution.
Yeah, that was really the message I wanted to come out, Steve.
Yeah. Yeah, but like I said, I think it is important to sort of know what the backdrop is in terms of expected returns, and the message that we're giving here actually is very consistent with what David was saying from Brunel. He was saying forward-looking asset class returns are coming down, and he was linking that also to an increase in inflation expectations and changes in risk-free rates. The other new piece of analysis that we've introduced is just putting, so what we're showing here is a funding level projection. So what this red line shows is actually how the funding level has tracked in absolute terms since the valuation date. So you can see at the end, we're at the end of Q1 here. And then this funneled out. This is giving you an idea of the range of outcomes of what the funding level could be over the next 20 odd years. And this type of what's noticeable actually is that the range of outcomes, the further you go out, look very wide. And that's pretty typical. What you might not be able to pick up on though is that you've got a slightly skewed range. So your upside potential is slightly greater proportionally than the downside. And that's a function of in effect, the risk management strategies that you've got embedded into your portfolio. So this is probably like one of the first times I think we've been able to demonstrate visually the kind of benefit from a strategy perspective of all the sort of various strategy elements that you've got in place. So again, there's still a think about sort of the positives here. You still got a lot of upside potential from your strategy. One of your greatest benefits is that you are a long-term investor. So you can generally take sort of long-term approach and be disciplined in that, albeit we know we need to sort of balance other sort of shorter-term considerations, especially around valuation points, liquidity, and cash flow management. But again, I think this is just useful to give you an idea of what the range of outcomes could be.
Thank you very much, Steve. I believe Liz may have a question next.
Yes, thanks. I was just going to say, when you say that this skew is because of the protection strategies in place, is that just the equity protection, or is it also the fact that we got the inflation?
It's all of them, Liz. So right. it's the equity and the inflation element as well.
Okay, that's fine. Great, thanks.
So yeah, so hopefully we've shown you two new pieces of analysis, kind of monitoring here, and I've given you an idea of how it can lead to more informed discussions about sort of longer term strategy issues. But the bit about the impact on the returns, we're saying don't get too worried about it. It's just going to be sort of one of many assumptions and issues that needs to be looked at the next valuation. And so the rest of the document, I mean, it's got actually this is another new piece of analysis that we're putting in. And so one question that has been posed to us in the past has been to think about ways of how can we assess, is the investment strategy that we've got in place, is it delivering what we need? So one way of looking at that is what returns have been achieved on the various parts of the portfolio versus asset class assumptions. And the idea here is if there's an asset class that has underperformed versus the assumption, that can lead to a discussion of looking to understand why. What was there an issue that wasn't expected, or has something come up? So I think I can see our colleague Hemel is looking to join, so that's good. So just to explain what we're showing here. So for BlackRock Global Equities, the blue bar shows the assumed return back at the last valuation date, strategy date. The The red cross is the actual performance that's been achieved over the latest 1 year period. And the darker diamond is the annualized return from that asset class / strategy since March 2019. And so what we're seeing here is for the equities, because of the very strong returns on equities over the last year or so, the actual performance delivered has been well in excess of what was assumed back in 2019. So that's a good thing. That's a strong positive. In terms of some of the other asset classes, it's a bit more of a mixed picture. Part of that can be explained because some of these mandates, some of these asset classes are actually relatively new. So it's like, it's too soon to make any sort of meaningful conclusions. That is probably of most relevance actually to the diversified returns strategy with Brunel. So that's only been incepted since last year. But on the positive side, we've had very strong returns from multi-asset credit over the last year, and the annualized return is just above what we're assuming from a strategic perspective. With property, but not surprising, that's an asset class that has been sort of more affected than others as a result of COVID concerns and issues. But hopefully we could see an uptick and an uplift in the valuations of UK property in particular as a result of coming out of lockdown and the vaccine rollout. With partners, the overseas property, that's an asset class that's always quite difficult to assess performance over short periods, quarter by quarter, because of the liquidity of the asset class, because of the cycle of drawdowns and getting some capital back. So with that one, I think we probably need to take a step back at some point and look at it over sort of a longer term period. And then Brunel Secured Income Fund income portfolio. Again, that's still in the kind of development phase. It has been impacted a little bit by property valuations in the UK, but actually we don't have any sort of fundamental concerns about that asset class. We think it's going to be sort of a strong source of stable inflation-linked cash flows. And then on the infrastructure, so IFM, their overall returns have been sort of in line, slightly above the strategic objectives, and it's been a good start from Brunel in terms of their renewable infrastructure strategy. So again, that's another lens, another way of looking at how the assets or how the strategy has performed versus the assumptions that went into the design of the strategy. And so there's the for reference, the performance of the underlying portfolios, and I think in future we're really sort of putting this in for reference. In future we'd expect to spend more time with Brunel, hearing from them about how the performance of their funds has been. Happy to take any other questions.
Thank you very much, Steve. Any colleagues wish to indicate they have further questions? Is that one from? No. Okay. So thank you very much, Steve, for your presentation. Then we go back now to, obviously we're on paper 10, and obviously we've been going through the various appendices. Does anyone have any other questions related to any of the appendices that we have for paper 10 that they would like to ask questions on? No? Okay, brilliant, thank you. We're not noting this because obviously we're not in a formal committee stage at the moment. So what we will do is just move on to item 8 on the agenda, which is the governance framework for the risk management strategies. So I believe, Liz, you're going to introduce this paper.
Thanks, Chair. As you know, we've had the risk management strategies, which is the equity protection, the LDI, and the low risk corporate bond, buy and hold corporate bond bond portfolio. We've had these in place for a while now, and they have developed as our strategic objectives have developed or evolved over time. So the strategies with moving the equity protection from static to dynamic, we've really now implemented them, and we think now that the panel needs to really focus on the strategic objectives and whether these strategies are actually delivering the outcome that they're meant to be, rather than the more operational implementation aspects of it. So in this report, what we've tried to do is set out the issues that we've identified that what we think makes the current arrangements with the panel's involvement and the level of panel and what they get involved with is it's slightly suboptimal, and we've put forward a proposed new framework. As this new framework delegates more to officers and in fact our advisors, we've then proposed that we have a new sort of like oversight scrutiny group that considers all the aspects, and where that group thinks that there's a strategic decision or a strategic implications, then those aspects or matters would then be escalated to panel. So panel aren't not involved in the strategic, and committees certainly not involved in the strategic, but what we're trying to do is make us have the right conversations at the right time, and then if things need to be resolved at a strategic level, take that to the panel. And that the group, what we've named the Funding and Risk Management Group, will actually make sure that the strategies in place are implemented in line to achieve the objectives, and they operate in line with the objectives. So we won't be ever doing anything outside the strategic objectives that have been set, or this group wouldn't be doing anything outside the strategic objectives. And then the group would also then report back to panel in terms of the activity it's taken, just for information. But as I say, they would escalate anything to panel that they think needs panel's input or decision making on. So it's all about transparency and assurance to try and get the right framework in place, but mainly so that we have the right and really robust and effective decision making and implementation and operational monitoring framework in place. So today, we're really asking you for your feedback, because changing the terms of reference itself would be a committee decision, And so our intention is to, if there is a support that we should be going forward with something like this, to actually take it to committee for them to have proper consideration of it, preferably in June. So, and that's obviously only if it's a face-to-face meeting where they can make decisions. So I was going to just open it up first of all, just to comments on it and see. It was a question I was asked earlier. It's very hard for us because very few LGPS funds also have these sort of risk management strategies in place, especially the number that we do. So there's not many models that we can look at, but we have looked at one or two models that are within the LGPS, and they generally do have a working group of some kind to assist the process. So I think we're in line. What we're putting forward is in line with what's out there, but it's not much out there.
Thank you very much, Liz, for introducing that. John, I believe you've got our first question.
Yeah, I mean, I think you're right, Liz. Now that to separate the operational and strategic issues, I think that makes good sense. Am I right that the FRMC there would be an extra report to panel at each panel meeting of what's gone on operationally, just so that we've got the oversight of that?
Sorry, I'll put myself on mute. Yeah, definitely. I mean, I think we would. It's like how we report investment panel activity to committee. It is to give that full transparency. Yeah, because I think otherwise you've got too many cooks, and the time between is wrong. So the FRMG makes good sense.
Thank you very much, John and Liz. I'm not seeing any other. Shirley.
Thanks. That's it. I'm pressing too many buttons here. So thanks for that. I think this makes good sense as well. Liz. I suppose I'm a little bit nervous about timing, because our panel meetings are every quarter. So if there was something that officers in this new committee decided upon during that time, would we be able to alert that to panel members, maybe if it is within the quarter's reporting, just so that we're not sort of behind the curve all the time on the information?
Yeah, I mean, I hadn't thought of that. I mean, yeah, if there was something that we thought needed to be done that was strategic, we would, I think, have to call an emergency panel meeting. But I think actually we could always give, we're always going to take notes, record what was the actions from the any of the meetings. So we can always share those where there are there's something that we're going to do.
Yes.
We can definitely share those in between meetings. I think that actually is a reasonable thing to be doing.
Yeah, I mean, it may not need to happen, but I think it's just to gain that reassurance, really. Thank you.
Yeah,
I think the situation, as I say, as between any meetings where a strategic issue arises, we would communicate as best we can with the panel and committee, and certainly the chair and vice chair, and use the delegated powers that the committee and the chair and vice chair have to sort of move those issues forward. But we wouldn't do it without engaging with the committee or panel.
Thank you, Tony, for that. Pauline.
I think my question's really been covered now, but I was just a wee bit worried about what would happen between panels, and I wondered if something maybe around the note going onto the library or something, just so that we can see what's happening, might make sense if we're alerted to the change.
Yeah, agreed. Yeah, we can do that.
Thank you. I'm not seeing any other questions, and obviously we're not making a decision today. This will just go to Avon Pension Fund Committee later. Sorry, Liz.
I was just going to say I'll change it slightly just to put that in place, that we will inform the panel in between meetings. I'll just have that in the actual terms, I think, just to make it clear for committee.
Okay, with that clarification, we're not doing anything because we're not making a decision. So that will just go forward to for Avon Pension Fund Committee in June is our next meeting, I believe. Yep, so that will go to them for the committee fully to consider and make a decision. So that's it on item 8 on the agenda. So we move now on to item 9 on the agenda, which is the legacy portfolio plan. And I believe Nathan will talk us through and introduce this paper.
Yep, thank you, Chair. So this is the plan to manage down our legacy portfolios. So these portfolios are sort of slightly less straightforward to transition to Brunel due to the sort of liquid nature of the underlying investment. So they need to be managed down carefully and over a period of time. And where there's no kind of natural fit for the legacy assets to transition directly into an existing Brunel portfolio, we'll be taking suitability advice from Mercer and reporting back to panel before any actions taken. So yeah, thank you.
Thank you, Nathan. Does anyone have any comments or questions with regard to what's been outlined as the way forward in this area? I'm not seeing anyone at this stage. So therefore, obviously, this will go to full committee to look at. No, it's just, sorry. So Liz, can you clarify for me? Thank you.
No, I was going to say it doesn't need to. I think that we just wanted the panel, because it's all about implementation of our strategy, just to be aware of the process that we were going to, how we were going to manage these legacy assets. So it doesn't need to go any further. But we will report back to you as and when.
Okay, thank you, Liz. Sorry for that slip up for my part. So we've done items 8, 9 and 10, or 10, 8 and 9. So now we're on to item 11 on the agenda, which is the forward agenda. And again, Liz, I think you're down to introduce this paper, which just outlines where we're going in the future. So you're on mute.
Sorry. I was aware that I've got today's meeting on this agenda, which was an error, so apologies for that. We will actually, two things. First of all, we need to agree the meeting dates for next year because we don't have them in our diaries, and then we will start to formulate the agenda, the forward agenda for that. And secondly, we have our second part of our equity review in September. And our intention is that we'll talk to Mercers later on, as we said in June, to decide exactly how we're going to do this meeting. But we were thinking the preference is to have it again, as we've had today, ahead of the panel meeting in September, if we can. So that's what we'll do. Otherwise, we will send round dates, and it will be after that date, after the panel meeting. But we will be arranging that shortly.
Okay, so with that update and information from Liz, we're not doing anything, we're not noting, because we're not an informal committee or in investment panel meeting. That was the last item on the agenda for today. So thank you very much to those members of the public who have been watching us on YouTube this afternoon. In future, if you want to get involved and see what we're doing on Avon Pension Fund, you'll have to come to a physical meeting, and normally they're in the Guildhall, and you can access those agendas from the Bath and North East Somerset Council website, and you'll be able to come along, and if you want to ask questions, you can do that through contacting Democratic Services of the Council. So thank you very much for viewing our meeting on YouTube today, and look forward to seeing you in person in future. So thank you very much, and I declare the meeting closed.